Welcome to my video on normally distributed asset returns. In this video, I'm going to talk about a concept that is widely used in asset management, very often as a starting point, and in this concept we assume that asset returns, like the returns for example from shares, are normally distributed. First, I'm going to talk about univariate returns. This means we are going to focus on only one specific asset and its returns. And later on, I'm going to talk about multivariate returns, where we consider multiple assets and their returns, and I'm going to introduce the concept of correlation. Very often it is assumed that assets, financial assets like shares, have returns that are normally distributed. And one very nice feature of this normal distribution is that when we consider only one specific asset, then we only need two parameters to describe its returns. The first parameter is the expected return, and the second parameter is the return standard deviation. The normal distribution sometimes is also called Gaussian distribution. So sometimes you might hear Gaussian distribution, which is just another name for this normal distribution. It stems from the German mathematician Carl Friedrich Gauss, who invented this concept a long time ago actually. Now let's move to the first parameter, the expected return. I believe expected returns are easy to understand. What they tell us is kind of the return over a specific time horizon that we can expect on average. So I give you a very simple example here. Consider that we have a share of company A and the price at the moment is 150 euros, and we know or assume that the expected return over the next year is 5%. So what do we expect the price to be in 1 year? 157.5 euros. This expected price means this is what we believe the price is going to be on average. And how can we calculate this? Well, here this stands for the expected value of the share price of company A, and we simply multiply the 150 euros, which is the price today, with 1 plus the 5%, which is the expected return over the next year. So 150 times 1.05, and the resulting expected price in 1 year is 157.5 euros. What is the notation that we use normally in asset management? This is the notation that we normally use. So it is the expected value of the return of asset I. What you also might see sometimes is you might see this Greek letter here, mu, which they often use in natural sciences. So you might also see this in some textbooks. Question: can we now assume that the realized observed return over the next year will exactly correspond to the expected return? And the answer is definitely not, because we must also consider the second parameter of a normal distribution, and this is the volatility. The second parameter of a normal distribution is what in asset management we typically call volatility, the volatility of a stock return. And it is a measure of dispersion, and I will come back to this in a second, and hence tells you how risky a stock is. So in asset management, typically we call it volatility. What is it? Well, the second parameter of a normal distribution is simply the standard deviation. So it is, in our context, the standard deviation of asset returns, and is typically denoted by the Greek letter sigma, a small sigma. So we know now these two parameters of a normal distribution, expected returns and volatility, and what we can say is that we assume rational investors to prefer higher expected returns and a low volatility, which means a lower risk. What I've done here is I have simulated the price evolution of 5 different assets, and they all have normally distributed returns, and they also all have the same parameters. They have an per annum expected return of 5%, and the per annum volatility is also 5%. So we would expect on average that each of these stocks, which at time 0 have a price of 100, that on average they should have a price of 105. But we can see that the price path for each of these assets is different, and that none of these assets reach a price of exactly 105 euros, which is due to the risk, the sigma of 5%. Let me do another simulation, again with for 5 assets, and again with the same parameters, 5% expected return and a volatility of 5%. See, this is another simulation for the price evolution, and maybe one more. And for each of these simulations I use the same parameters, 5% expected return and 5% volatility. Let me now change the volatility from 5% to say 2%, and let's see what is going to happen. You can see that now the price evolution becomes much more smooth for each of these assets, and this is because we have reduced the risk. And again, if we increase the sigma to say 10%, the result looks like this. I understand that most people have no problems at all to interpret the expected return of an asset, but a lot of people have problems with the interpretation of volatility. And indeed, the volatility is more difficult to understand than the expected return. But let me give you one piece of interpretation so that you can get a better understanding for the specific number, for the sigma, for the volatility. And this is one way of interpreting it, the volatility, which I also always keep in mind. And it helps to understand. So this interpretation is that if we assume a normal distribution, then with a 68% probability roughly, the realized returns are in the range of the expected return plus minus the volatility. So consider that we have stock A, and stock A has normally distributed returns, and the expected return is 5%, and the volatility is 10%, then with a 68% probability, the realized returns are between -5 and plus 15%. So the expected return of 5% minus the volatility of 10%, that's the -5%, that's the lower threshold, and 5% plus 10%, that's then the 15% here. A related question is, what is the probability that they are, say, below 5% or above 15%? Well, here we can consider that if the area here under the density function is 68% or 0.68, and we know that the area under a density function is always equal to 1 or 100%, then this implies that 32% should be outside this blue area. And as the normal distribution is a symmetric distribution, we can assume that if there's a 68% probability that the returns are between -5 and plus 15%, then there should be a 16% probability that the stock returns are below 5% and a 16% probability that the stock returns are above 15%. I now want to look at some examples from practice by having a look at 5 stocks that are traded at the Vienna Stock Exchange, and these 5 stocks are the largest constituents of the ATX, the Austrian Traded Index. Per Ultimo 2019, these 5 stocks together accounted for 57% of the market capitalization of the stocks in the Austrian Traded Index. I have for these 5 stocks now estimated the parameters expected returns and volatility for monthly returns, not annual returns, and I estimated these parameters on the basis of the 36 most recent return observations, that is 3 years of return observations at the end of 2019. So we can see that of course the parameters differ. We see some stocks that had high average return in the past 3 years, which then would imply, if we base our estimations on historical data, that also the estimated return for the next month would be high. For the Verbund, this would be almost 4% per month, and we see others that have performed less well. And we can also see that we have different values for the volatility from less risky to more risky. Let me repeat that these values are purely based on historical observations of the prior 3 years. And assuming a normal distribution and assuming that these parameters are correct, we can also observe here or see here the 68% range that we believe the stock returns will be in the next month. That would then be January 2020. I have estimated these parameters from historical data, the parameters for the expected return and the volatility, and this is typically the first approach that one uses in practice. Unfortunately, there is no industry standard what exact data we should use. So what we do quite often in asset management, we use 3 years or 5 years of monthly return observations, which then would be either 36 or 60 monthly observations. But there are also other approaches. So some people use 2 years of daily returns, which are then approximately 500 observations, because there are approximately 250 trading days per year. And another approach would be to use 2 years of weekly data to estimate parameters for daily and weekly data. The estimation of the expected return from historical data is quite easy. So what you do is you look at the most recent N return observations. I used 36 return observations, and then simply take the arithmetic mean, that is the average of these returns. So what you do is you sum up the most recent N return observations and then divide by N. I have an example here where I have estimated the expected monthly return for Erste Group, and I did this on the basis of only 12 monthly returns. I used the 12 returns of 2019, and I did this mainly for presentation purposes. So normally you don't only use 1 year of monthly returns, but the presentation becomes easier then. So what you can see here is I have 12 monthly return observations. They are both positive and negative. You sum them up. The result is 16.8%, and then divide by 12, which gives us an average return of 1.4% for monthly returns, and this then would be our estimate for the expected return for Erste Group. Now let's turn to the estimation of the volatility from historical data. The volatility is estimated as the so-called sample standard deviation of the most recent N return observations, and this is the formula for the sample standard deviation. Now, I understand that some people don't like formulas so much, so I try to translate this formula into a cookbook recipe, which I have summarized here. So the first step would be to calculate the deviations from the mean. This is what we have here for the return observations that I use. Then in a second step, I square these deviations. I take them to the power 2. Then in the next step, step 3, I sum them up. So I have the sum of the squared deviations. Then divide by n minus 1, not by n but n minus 1, to obtain the so-called variance sigma squared, the variance, and then in a last step take the square root to obtain the volatility. Let's look at our example from Erste Group and let's see how we can calculate the sample standard deviation, our estimate for the volatility. So again, here we have the 12 return observations. We have already calculated the expected return, which is 1.4%. And then our first step is to calculate the deviations from the mean. So that is the observed return minus the expected return. And we see for January 2019, the deviation from the mean is 3.25%. So 4.65% is 3.25% above the expected return of 1.4%. In March 2019, we observe a return of 1.47%, which is 2.87% below the expected return, and so on. Then, next step, we square this deviation. We take them to the power of 2, and you can see that because we square them, now we have only positive values here. These are the squared deviations. I take the sum of these and then divide by 11, which is the variance. And finally, I take the square root of the variance, and the result is 0.063596, which means the volatility is roughly 6.36%. I believe that it is important to understand how exactly these parameters are calculated, the expected return and the volatility respectively, when we talk in statistical terms, the arithmetic mean and the sample standard deviation. But of course, in our practical everyday life, we would not always calculate these values ourselves, but rather download them from data providers or use some computer programs like, for example, Excel, that offers some built-in functions. You can see the functions in this table. So for the arithmetic mean that we need to calculate the expected returns, we have the function called average, and then you simply choose the range with the observed returns that you use as the basis for your estimation. And for the sample standard deviation, we have this function here. I now want to show you some parameter estimates that I have done for the 5 stocks from the Vienna Stock Exchange. The estimates are always based on the previous 36 months. I started here in February 2013, so that estimate was based on monthly returns from February 2010 till January 2013. It is simply the average of these monthly returns. You can see that the estimates vary amongst the different assets and also they vary over time. Keep in mind, it's just the average of the prior 3 years of monthly returns. So we see some assets like, for example, Verbund have, according to this calculation, a very high expected return, which implies that the past 3 years displayed a very high return, and in contrast to this, the estimate for voestalpine is lower than those of the other 4 stocks. Now let's look at the estimates for the volatility. Also here we see they vary between the different assets and they vary over time. Interestingly, we see that Verbund had only a medium volatility, and this is contrasted by voestalpine with the low expected return and the high risk parameter volatility. Let us now change our perspective and move from the univariate perspective, where we always investigated one single asset, respectively its returns, to the multivariate perspective, where we are interested in whether over time the returns of two different assets behave in a similar manner. And one measure for this linear dependence is the correlation coefficient. The correlation coefficient can take values from -1 to +1. And let me give you a first somewhat sloppy definition so that you get an idea what correlation tells us. So if we observe positive correlations, then this assumes that the assets returns, they tend to move together in the same direction. When the correlation is negative, this indicates that the returns, they move in opposite direction. And a correlation coefficient of 0 indicates that the returns are uncorrelated. What I show you here are joint realized returns of asset A and asset B that I have simulated. Both assets have normally distributed returns, and the parameters of these normal distributions you can see on the left hand side. So asset A has an expected return of only 1% and a volatility of 5%, whereas asset B has a much higher expected return, 4% that is, but also a much higher volatility of 15%, which implies that asset B is much more risky. What I additionally assumed is that the correlation between the returns is 0.5, so we see a positive correlation here. And I have displayed these simulated returns in a scatter plot. The scatter plot displays joint observation for that I've simulated as a blue dot. Let us consider, for example, this blue dot here. It is a joint simulated return, so in that specific time period, asset A had a return of roughly, well, let's say 10%, and at the same time asset B had a return of almost 40%. What we can see here is that there is a tendency that at the same time both stocks have jointly very high returns, high in the sense of that they are above their average, above the expected returns. And we can also see that quite often they have jointly low returns, returns below their mean. In contrast, we don't observe very often that the one stock has high returns and the other one has low returns. So we see comparably few dots in this area. I will do some more simulations with the same parameterization. what happened now if I change the correlation from 0.5 to 0.8, which is very high. We can observe that now this tendency of this joint co-movement is much stronger than it used to be with the correlation of 0.5, and we can hardly see any observations here, but a lot of observations here. Let me now increase the correlation to 0.9, and you see that this effect becomes even stronger. Now let's consider a very low positive correlation, 0.2. And you can see that now there's still this tendency of joint co-movement, but we can also see in quite some cases returns where the one asset has returns below its mean, whereas the other one has returns above its mean. In the context of asset management, a low correlation between the asset returns that you have in your portfolio seems desirable. What is the idea behind? Well, consider the following. If the correlation is low, then if the return of one asset is extremely low, that is very negative, then there is less probability that the other asset's return will move also exactly into this extremely negative returns. So some of them might also have positive returns then, and this reduces the overall risk of your portfolio, that is the portfolio return volatility. So asset managers actively look also for assets that have a low correlation to other assets to reduce risk. How can we calculate the correlation of returns on the basis of historical data? Well, here you can see the formula for the correlation. The mathematical notation is a rho, so the correlation between I and j, rho ij, is calculated as the covariance between I and j divided by the volatility of asset I times the volatility of asset j. We already know how to calculate the volatilities based on historical data, so what we must have a look at now is how can we calculate the covariance. And in this context that I talk about here today, I consider the covariance only to be an auxiliary variable that I need in order to calculate the correlation, which is definitely easier to interpret than the covariance. So this is the formula for the covariance. Let me once again try to give you a cookbook recipe how you can calculate the covariance yourself. Well, the first step is, again, you have to calculate deviations from the mean, but now you do not consider, like in the case of the volatility, only one asset, but you consider asset I, and then also a second asset J. And for both of these, in a first step, you calculate the deviations from the mean. In a second step, you multiply these here, so the deviations from the mean of the first asset times the deviation from the mean for the second asset, and then you sum these products. You know, a product is just a mathematical word for a multiplication, or a value that results from a multiplication. So you sum these and then finally divide by n minus 1 to obtain the covariance. Let's look at an example again. So what we want to do here is we want to calculate the covariance between Erste Group and OMV for January 2020 based on the monthly return of the year 2019. Let me repeat that normally we use at least 3 years of monthly data, but for the purposes of presentation I restrict myself to only 1 year. So we have here the returns for Erste Group, and here we have the returns for OMV. We can calculate the expected return, respectively the average for both stocks, and then can calculate the deviations from the mean, which we have here for Erste Group and here for OMV. And then for all 12 observations we must multiply this value with this value. So we have these 12 products here. And you might have seen already that in contrast to the calculation procedure that we used for the volatility, where we squared the deviations and hence only had positive values, we see here positive and negative values. When do we see positive values? We see positive values when the joint returns for asset I is above its mean, and for asset J is also above its mean, as was the case in January 2019. Or we see also positive values here if they were both jointly below their means. In contrast, we see negative values if one asset has a return below its mean and the other one has a return above its mean. So the covariance can also be negative, which indicates that then also the correlation would be negative. And of course it can also be positive, which implies a positive correlation. So we now take the sum of these 12 products, this is this value here, and divide by 11. n minus 1, we have 12 observations, so we divide by 11, and this is the value for our covariance. And in a last step, we use the formula that I've just presented to calculate the return correlation out of the covariance and the volatilities of the two single stocks. So this is the covariance that we have just calculated, and this is the volatility of Erste Group, and this is the volatility of OMV based on our 12 observations. And the resulting return correlation is 0.47 or 47%. Of course, also for the correlation and the covariance, There are functions in Excel that you can use to obtain these results more easily. They are displayed here in this table. Again, I investigated a bit on the time series of the 5 stocks from the Vienna Stock Exchange, and what I displayed here was the estimated correlation, again based on a rolling window of 36 months, between Erste Group and the other stocks. And what we can observe is that seemingly in the recent time there was a lower correlation than we would have estimated some 7 years ago. The comparably high correlation that seems to last over time between Erste Group and Raiffeisen Bank International does not come at a surprise, because they come from the same industry. And what seems very interesting from a risk management point of view is the indeed very low, even slightly negative correlation between Erste Bank and Verbund, which means that in the last 3 years the observed returns seem to have been in the opposite direction. To finish this first short presentation, I wanted to show you one final concept, the so-called correlation matrix, which allows us to display correlations between more than 2 assets in a compact manner. What I have displayed here is the correlation that I have estimated per ultimo 2019 based on the 36 months observations. And how can you read this table? Well, if you're interested in the correlation of Erste Group with the other stocks, then you can look at the first row and find here the correlation with OMV, with Raiffeisen Bank International, the slightly negative even correlation between Erste Group and Verbund, and a correlation of 0.43 between Erste Group and voestalpine. In the diagonal of such a correlation matrix, we always see ones, because the correlation of the return of one asset with itself is always equal to 1. And you can also see that the values are kind of mirrored along the diagonal. So for asset managers, as I have said, low correlations are interesting. We can see that the correlation of Verbund with the other 4 assets seems to be comparably low, which makes Verbund from the risk diversification perspective an interesting candidate to add to your portfolio. That was my presentation on multivariate normally distributed asset returns. I hope you enjoyed watching this video, and I hope also that it was a bit helpful. Thank you for your attention.